Welcome back, fellow investors, to another episode of Wealth Building Wisdom. Today, we're unveiling the ultimate blueprint to financial freedom. Imagine a life where work becomes optional, where your investments generate enough passive income to sustain your lifestyle, allowing you to pursue your passions and dreams without constraints. Well, buckle up because we're about to reveal the 5 assets that can make this dream a reality. Diversification is a fundamental principle of investing to manage risk. Stocks. Invest in a globally diversified index fund or ETF, exchange-traded fund, that tracks the performance of the global stock market. This provides exposure to a broad range of companies across various sectors and geographies. Bonds. Consider investing in a bond index fund or ETF to provide stability and income to your portfolio. Bonds are generally less volatile than stocks and can provide steady returns over time. Real estate investment trusts, REITs. REITs offer exposure to the real estate market without the hassle of owning physical properties. They typically pay attractive dividends and can provide diversification benefits to your portfolio. Commodities. Allocate a portion of your portfolio to commodities such as gold, silver, or diversified commodity ETFs. Commodities can act as a hedge against inflation and provide diversification benefits due to their low correlation with stocks and bonds. Alternative investments. Consider alternative investments such as private equity, hedge funds, or infrastructure funds to further diversify your portfolio and potentially enhance returns. It's important to consult with a qualified financial advisor who can assess your individual financial situation, risk tolerance, and investment goals before making any investment decisions. Additionally, achieving financial independence typically requires careful planning, disciplined saving, and prudent investing over the long term. Stocks to invest in requires comprehensive research and analysis, considering factors such as the company's financial health, growth prospects, competitive advantages, industry trends, and macroeconomic conditions. That said, here are 5 well-established companies in the UK and the United States that have historically been regarded as solid investments. However, please conduct your own research or consult with a financial advisor before making any investment decisions. United Kingdom, Unilever plc, ULVR. Unilever is a multinational consumer goods company with a diverse portfolio of household brands, including Dove, Lipton, and Ben & Jerry's. It has a long history of consistent performance and a strong global presence. Diageo plc, DGE. Diageo is a leading alcoholic beverages company, owning popular brands such as Johnnie Walker, Guinness, and Smirnoff. It benefits from its diverse product portfolio and global distribution network. GlaxoSmithKline plc, GSK. GlaxoSmithKline is a pharmaceutical and healthcare company engaged in the research, development, and manufacturing of various medicines, vaccines, and consumer healthcare products. It's one of the largest pharmaceutical companies in the world. BP plc, BP. BP is one of the world's largest integrated oil and gas companies, operating in all areas of the oil and gas industry, including exploration, production, refining, distribution, and marketing. It has a significant presence in the UK and globally. British American Tobacco plc, BATS. British American Tobacco is one of the largest tobacco companies globally, with a portfolio of well-known cigarette and tobacco brands. Despite regulatory challenges, it has shown resilience over the years. United States, Apple Inc. AAPL. Apple is a technology giant known for its iconic products like the iPhone, iPad, and Mac computers. It has a strong brand, loyal customer base, and a track record of innovation and financial success. Microsoft Corporation, MSFT. Microsoft is a leading technology company involved in software development, cloud computing, hardware, and other services. Its diverse revenue streams and dominant market positions make it a compelling investment choice. Amazon.com Inc. AMZN. Amazon is the world's largest online retailer and a major player in cloud computing, digital streaming, and artificial intelligence. Its relentless focus on customer satisfaction and innovation has driven its growth over the years. Johnson & Johnson, J&J. Johnson & Johnson is a diversified healthcare conglomerate engaged in pharmaceuticals, medical devices, and consumer healthcare products. It has a long history of stability, strong brands, and global reach. Alphabet Inc. GOOGL. Alphabet is the parent company of Google and several other businesses. Google dominates the online search market and is a leader in online advertising, cloud computing, and various other technology initiatives. Remember, investing in individual stocks carries risks, including the potential for loss of principal. It's crucial to diversify your portfolio and consider your risk tolerance and investment objectives carefully. Additionally, consider seeking advice from a qualified financial advisor. When considering investing in bonds, it's important to understand that the best bonds for you depend on your investment goals, risk tolerance, and the current economic environment. Here are 5 types of bonds commonly considered by investors in both the UK and the United States. United Kingdom, UK government bonds, gilts. Gilts are issued by the UK government and are considered relatively low-risk investments. They offer fixed interest payments and are backed by the full faith and credit of the UK government. Corporate bonds. Bonds issued by UK-based corporations offer higher yields compared to government bonds but also come with higher credit risk. It's essential to research the creditworthiness of the issuing company before investing. Municipal bonds, gilts. Similar to corporate bonds, municipal bonds are issued by local authorities in the UK to finance public projects. They offer tax advantages and can provide a steady stream of income for investors. UK Treasury Index-Linked Securities, UKTILS. These bonds are linked to inflation, offering protection against rising prices. They provide a hedge against inflation risk and are suitable for investors seeking to preserve purchasing power. High-yield bonds, also known as junk bonds. High-yield bonds offer higher yields to compensate for their higher credit risk. They are issued by companies with lower credit ratings and can provide attractive returns for investors willing to take on additional risk. United States, U.S. Treasury bonds. Treasury bonds issued by the U.S. government are considered one of the safest investments in the world. They offer fixed interest payments and are backed by the full faith and credit of the U.S. government. Corporate bonds. Similar to the UK, corporate bonds in the US offer higher yields compared to government bonds but also come with higher credit risk. Investors can choose from a wide range of investment-grade and high-yield corporate bonds. Municipal bonds, MUNIS. Municipal bonds issued by state and local governments in the US offer tax advantages, making them attractive to investors in higher tax brackets. They finance essential public projects such as schools, hospitals, and infrastructure. U.S. Treasury Inflation-Protected Securities, TIPS. TIPS provide protection against inflation by adjusting their principal value based on changes in the Consumer Price Index, CPI. They offer a guaranteed real return and can help preserve purchasing power. Agency bonds. Agency bonds are issued by U.S. government-sponsored entities such as Fannie Mae, Freddie Mac, and the Federal Home Loan Banks. They are considered relatively safe investments due to implicit or explicit government guarantees. Before investing in bonds, it's essential to evaluate factors such as interest rate risk, credit risk, and inflation risk. Additionally, consider consulting with a financial advisor to determine the most suitable bond investments based on your financial situation and investment objectives. Investing in real estate investment trusts, REITs, can be a good way to gain exposure to the real estate market without directly owning physical properties. Here are 5 well-known REITs in both the UK and the United States that investors often consider. United Kingdom, British Land Company plc, BLND. British Land is one of the largest property development and investment companies in the UK. It owns and manages a diverse portfolio of commercial properties, including office buildings, retail centres, and industrial estates. Land Securities Group plc, Land Securities is another major player in the UK real estate market. It focuses on developing and managing prime commercial properties in London and other key cities across the UK. Segro plc, SEGRO specialises in industrial property investment and development, with a focus on warehouse and distribution centres. It has a significant presence in the UK and continental Europe. Derwent London plc, DLN. Derwent London is a leading owner and developer of commercial properties in central London. It focuses on creating vibrant office spaces for technology, media, and creative companies. Primary Health Properties plc, PHP. Primary Health Properties is a UK-based REIT that specialises in healthcare real estate. It owns a portfolio of medical centres, GP surgeries, and other healthcare facilities across the UK. United States, Simon Property Group Inc. SPG. Simon Property Group is the largest retail REIT in the United States and one of the largest in the world. It owns and operates premier shopping malls and outlet centers across North America and Asia. Prologis Inc. PLD. Prologis is a global leader in logistics real estate, owning and operating distribution centers, warehouses, and industrial properties in key logistics hubs worldwide. Equity Residential, EQR. Equity Residential is one of the largest residential REITs in the United States. It focuses on owning and operating high-quality apartment communities in desirable urban and suburban markets. American Tower Corporation, AMT. American Tower is a leading owner and operator of wireless and broadcast communications infrastructure, including cell towers and antennas. It has a diversified portfolio of properties across the United States and internationally. Healthcare Trust of America Inc. HTA. Healthcare Trust of America is a REIT that specializes in medical office buildings and healthcare-related facilities. It owns a portfolio of properties leased to healthcare providers across the United States. Before investing in REITs, it's essential to conduct thorough research, considering factors such as the REIT's property portfolio, geographical diversification, management quality, and financial performance. Additionally, consider consulting with a financial advisor to determine the most suitable REIT investments based on your investment goals and risk tolerance.
Index fund investing is a passive investment strategy that involves investing in a portfolio of assets that aims to replicate the performance of a specific market index. A market index is a representation of a particular segment of the financial market, such as stocks, bonds, or other assets. The goal of index fund investing is to achieve returns that closely track the performance of the chosen index. Here's how index fund investing works. Fund composition. An index fund holds a diversified selection of assets that mirror the composition of a specific market index. For example, an index fund tracking the S&P 500 index would hold a proportionate amount of the 500 companies included in that index. Passive management. Unlike actively managed funds, where fund managers make individual security selections and attempt to outperform the market, index funds are passively managed. This means that the fund's holdings are not frequently bought and sold based on market forecasts or stock picking. Instead, the fund's holdings are adjusted only when the underlying index itself changes, due to additions, deletions, or changes in weightings. Low costs. Index funds are known for their relatively low expenses compared to actively managed funds. Since they don't require the same level of active management and research, index funds typically have lower management fees and operating expenses. Market returns. The objective of index fund investing is to replicate the returns of the chosen index, minus any fund expenses. If the index goes up, the value of the index fund's shares should also increase, and if the index goes down, the value of the fund's shares should decrease. Diversification. By investing in an index fund, you achieve instant diversification across the assets in the index. This helps spread risk, as the fund holds a broad range of companies or assets. Long-term approach. Index fund investing is generally considered a long-term investment strategy. It aligns well with the philosophy of buy and hold, as investors aim to capture the overall growth of the market over time. Market efficiency. Index funds assume that markets are generally efficient, meaning that prices already reflect all available information. Therefore, trying to consistently outperform the market through active management may be challenging. Popular examples of market indexes that are commonly tracked by index funds include the S&P 500, the Dow Jones Industrial Average, the Nasdaq Composite, and various bond indexes. It's important to note that while index funds provide a simple and cost-effective way to gain exposure to a broad market segment, they also come with certain risks. If the index itself experiences a downturn or significant volatility, the value of the index fund will also be affected. Additionally, index funds may not provide the potential for higher returns that active management might offer if a skilled fund manager makes successful investment decisions. Before investing in index funds or any other investment vehicle, it's advisable to conduct thorough research, consider your investment goals and risk tolerance, and, if necessary, seek advice from a financial advisor. Certainly. Here's a beginner's guide to index fund investing for passive income. Understand the basics. Learn what index funds are and how they work. Understand that they aim to replicate the performance of a specific market index. Familiarize yourself with key investing terms such as diversification, risk, return, expense ratio, and compounding. Set clear goals. Determine your investment goals and time horizon. Are you investing for retirement, a major purchase, or simply to generate passive income over the long term? Educate yourself. Read books, articles, and watch videos to build a foundational understanding of investing in index funds. Learning the basics can help you make informed decisions. Choose an index. Decide which market index you want to track with your index fund. Common choices include the S&P 500, total market indexes, or specific sector indexes. Select a brokerage account. Choose a reputable online brokerage that offers access to a variety of index funds with low expense ratios. Look for a user-friendly platform and good customer support. Open an account. Open a brokerage account and fund it with the amount you're comfortable investing. Most brokerages offer different account types, such as individual, joint, or retirement accounts. Research and select funds. Research different index funds that track your chosen index. Look for funds with low expense ratios, as this can have a significant impact on your returns over time. Diversify. Consider diversifying your investments by choosing index funds that cover different asset classes, e.g., stocks, bonds, international markets, to spread risk. Invest regularly. Implement a consistent investment plan by contributing to your chosen index funds on a regular basis. This can be monthly or quarterly, depending on your financial situation. Automatic investing. Many brokerages offer automatic investing options, allowing you to set up recurring deposits into your index fund accounts. This helps you stay disciplined and take advantage of dollar cost averaging. Reinvest dividends. If the index fund pays dividends, consider reinvesting them back into the fund to take advantage of compounding. Stay patient and disciplined. Passive income from index funds takes time to grow. Avoid the temptation to constantly monitor your investments or make impulsive decisions based on short-term market fluctuations. Review and adjust. Periodically review your investment portfolio to ensure it aligns with your goals. Rebalance if necessary to maintain your desired asset allocation. Stay informed. Stay informed about market trends and changes that could affect your index funds. However, avoid making knee-jerk reactions based on short-term market movements. Consult a professional. If you're uncertain or have complex financial needs, consider consulting a financial advisor. They can provide personalized guidance based on your situation. Remember, index fund investing is a long-term strategy, and building significant passive income through this approach requires patience, discipline, and a commitment to consistently invest over time. It's also important to remember that all investments carry some level of risk, so make sure to do your research and make informed decisions. Thanks for watching. Please like, subscribe, share and click the notification bell. Thank you.